All right, let's dive into a real financial whodunit today. We're going to put on our detective hats and piece together the clues behind a crazy crypto collapse, a token called Siren. Our mission? To figure out what was really going on behind the scenes.
And this is the million-dollar question, isn't it? I mean, how does something rocket up over 2,000% only to completely implode and lose nearly $1 billion in value in just 10 days? It sounds impossible, but as we're about to see, the clues were hiding in plain sight.
Okay, so first, let's set the scene. Out of nowhere, this token, Siren, appears, and it had the perfect story, right? It was this blend of two of the hottest narratives out there, artificial intelligence and meme culture. It was basically engineered to grab the market's attention, and boy, did it ever.
Get this, in just 90 days, the price exploded by 2,450%. That is not a typo. A rally like that creates an absolute tidal wave of hype. And you know what that means? FOMO, fear of missing out. Thousands of regular investors jumped in, hoping to catch the rocket ship to the moon.
And then, the music stopped. Just 10 days after hitting its peak, Siren crashed hard. We're talking a 91% drop. The speed of that reversal was just brutal, giving anyone who bought at the top a serious case of financial whiplash. To really put that into perspective, almost $850 million in value just vanished. Poof, gone in 2 weeks. This wasn't just some little dip, it was an absolute catastrophe. And that begs the real question for our investigation. What on earth caused this?
To find the answers, we don't have to guess. We just have to follow the money. And the beautiful thing about crypto is that the ledger, the transaction history, it's public. So we can follow that digital trail and see exactly what happened.
Now, this whole process, it's called on-chain analysis. Think of it like financial forensics for the crypto world. It lets us peek behind the curtain and see what the big, sophisticated players were doing, while everyone else was getting swept up in the hype.
And this isn't just some wild theory. Check out this quote from a CCIN report. It says, "The reason for the collapse is right there on the blockchain, documented with, and I love this phrase, uncomfortable precision." So let's look at the first big clue.
Okay, here's clue number one, and it's a big one. An analysis from Bubble Maps revealed that a tiny, interconnected cluster of about 200 wallets controlled over half of all the Siren tokens in existence. That is a massive flashing red light. When that few people control that much of the supply, they can move the market however they want.
And this is where the plot really thickens. The famous on-chain detective ZachXBT started digging and connected wallets in that cluster to a huge crypto market maker called DWF Labs. So now we've got an incredibly concentrated supply, possibly all linked to one single, very sophisticated entity.
So we know who had the tokens. The next piece of evidence shows us exactly what they did with them. We can do this by tracking something called exchange net flow, which is just a fancy way of saying we're watching tokens move onto and off of crypto exchanges. It's how you spot the smart money's signature move.
See, these insiders have a playbook, and it's brutally effective. Step 1. They move their giant stash of tokens off of exchanges. This creates scarcity, right? Less supply for sale, so the price goes up. Step 2. They let the hype build. And then, step 3, right at the peak when everyone is buying, they flood all those tokens back onto the exchanges for the final move. Step 4. They sell. They dump their bags into the retail buying frenzy.
And look at this chart. It's the playbook, perfectly executed. From November to January, nothing's happening, the net flow is flat. Then in February, as the price starts climbing, see those big red downward spikes? That's them pulling tokens off exchanges, creating that scarcity. And then, look at late March, a massive green spike upwards. That is the unmistakable signature of insiders moving their tokens back onto exchanges to cash out at the top.
So this brings us to a really critical idea for any investor. After a huge crash, a lot of people think, oh, it's on sale, time to buy the dip. But what if it isn't a bargain? What if it's something way more dangerous, something called a value trap?
You can see the dilemma people were in. On one hand, you had the bull case, which was all hype, a powerful story about AI and memes, these wild price predictions, and the memory of that huge rally. But on the other side, the actual data was screaming danger. Extreme supply concentration, the number of people holding the token was actually going down, and market sentiment had turned negative. Hype versus reality.
And that's the textbook definition of a value trap. It's an asset that looks cheap compared to where it used to be. But it's not a bargain. It's cheap for a reason. The market has correctly figured out that the project is broken or heading towards zero, and the low price is just reflecting that bleak future.
And that is exactly what was going on with Siren. That low price after the crash wasn't an opportunity. It was a warning sign. It was the market telling you that the game was rigged, that the integrity of the token had been completely compromised by all that insider selling.
So, the big takeaway here is, how can you avoid falling for a trap like this yourself? Well, the Siren story actually gives us a fantastic playbook, a checklist of red flags to watch out for.
Think of this as your personal value trap detector. First, always check for extreme supply concentration. Second, be suspicious if the hype and price action are totally disconnected from the fundamentals, like a shrinking user base. Third, learn to spot the on-chain signs of insider selling or distribution. And last but not least, be super wary of a great story that doesn't have any real substance to back it up.
You know, this quote really nails it. The goal isn't just to buy something that's cheap. The goal is to buy something that's good. A discount is only a real bargain if the thing you're buying, the project, the business, is actually solid and built to last.
So the story of Siren leaves us with this one big, lingering question. It's a perfect example of how a powerful, exciting story can completely overshadow clear data that's flashing warning signs. It really makes you wonder, in the wild world of crypto, which one wins out more often, the story or the data?